Starting to invest in the stock market can feel intimidating if you've never done it before. With all the financial jargon and different investment options, it's easy to feel overwhelmed. However, investing in stocks is an important part of long-term financial planning and pretty straightforward once you understand the basics. This guide will walk you through how to get started investing in stocks as a beginner. Open a brokerage account. The first step is choosing an online stock brokerage account to buy and sell shares through. Look for one with low or no trading fees and excellent customer support. Some top options for beginners include Fidelity, Schwab, and Vanguard. To open an account, you'll need to provide basic personal information like your address, social security number, and source of funds. Account minimums are typically low, around $500 or less. Once approved, you can link your bank account to deposit funds to invest. Start with blue-chip stocks. Rather than trying to pick individual risky stocks right off the bat, begin by investing in large, well-known, blue-chip companies. These include household names that have proven track records of steady growth and dividend payments. Some good starter blue-chip stocks include Microsoft, Apple, Johnson & Johnson, Procter & Gamble, and Coca-Cola. Filter stock screener results by market capitalization, earnings stability, and dividend yield to find other large, stable companies. Diversify your initial investments across at least 10-15 stocks. Keep costs low with ETFs. Exchange-traded funds, ETFs, allow you to own shares of a portfolio containing many stocks in a single investment. ETFs are extremely cost-effective since they charge very low annual expense fees compared to mutual funds. Popular low-cost ETFs include Vanguard's S&P 500 ETF, VU, which tracks the entire U.S. stock market. For international exposure, consider total world stock ETFs like Vanguard's FTSE All-World ETF, VEU, with over 8,000 stocks worldwide. ETFs take the work out of assembling a diversified portfolio. Use dollar cost averaging. Rather than put all your investment funds in at once, utilize dollar cost averaging. This means contributing set amounts on a regular schedule, like $100 monthly or $500 quarterly. Over time, you'll end up buying more shares when prices are low and fewer when high, lowering your average cost per share. Dollar cost averaging takes the emotion out of timing the market and forces discipline. It's one of the best strategies for long-term returns with less volatility than lump sum investing. Automate this through your brokerage for hassle-free investing. Recommended investing websites. Here are some top online resources for beginning investors to stay informed and make stock selections. Investopedia. Learn the basics about stocks, ETFs, and other key topics through educational articles, videos, and stock simulations. CNBC. Follow breaking business news, expert stock picks, SEC filings, and earnings reports on companies. Great for staying current. Seeking Alpha. Comprehensive analysis, research, and earnings call transcripts on individual companies. Filter by sectors. Yahoo Finance. Easy-to-use portal for real-time stock quotes, charts, news, and SEC fillings. Screeners help find stocks by metrics. MarketWatch. In-depth reporting by sector specialists with screening tools and portfolio trackers included. Finviz. Powerful stock screener offers screening by fundamentals, technicals, and ratings from Wall Street analysts. Be sure to check company sites and financial documents like earnings reports and balance sheets as well. Bookmark trustworthy resources for ongoing education. Recommended investing books. Reading up on investments is one of the best ways to learn. Consider starting with these classic titles. The Intelligent Investor by Benjamin Graham. Timeless guide to value investing focusing on company fundamentals over stock fluctuations. A Random Walk Down Wall Street by Burton Malkiel. Explains how average market returns are nearly impossible to beat with an active strategy. Makes the case for indexing. The Little Book of Common Sense Investing by John Bogle focuses on keeping costs low through index funds from the Vanguard founder. The Boglehead's Guide to Investing by Larimore et al. Easy-to-understand resource from the Bogleheads Forum covering asset allocation and portfolio building. Stocks for the Long Run by Jeremy Siegel. Data-driven book on the superior performance of equities over other investments on a historical basis. One Up on Wall Street by Peter Lynch. Legendary fund manager shares strategies for researching companies and finding hidden gems. Adding books to your investing curriculum ensures you understand core concepts behind long-term wealth creation in stocks. Take it step by step. Successful investing is a marathon, not a sprint. As a beginner, focus on opening an account, purchasing your first ETFs or blue-chip stocks, and starting a consistent savings plan through dollar-cost averaging. Rely on educational resources to expand your knowledge over time as markets change. With patience and discipline, investing in stocks can be a straightforward way to grow your money. Now get started on your investing journey. Here are some additional tips for beginner stock investors. Start small. Don't invest more than you can afford to lose. Think of stocks as a long-term savings vehicle, not a get-rich-quick scheme. Be patient. Resist the urge to constantly trade. Successful investing is a slow process of regular contributions and leaving your money to grow. Diversify your portfolio. In addition to diversifying across many companies, consider including industry sectors, domestic and international stocks, and small caps too over time. Rebalance periodically as some holdings increase in value more than others. Rebalance back to your target allocations periodically to maintain diversification. Automate where possible. Set up automatic transfers and dividend reinvestments so investing becomes effortless and emotion-free. Know your risk tolerance. Higher risk investments like individual stocks or small caps could lead to bigger losses if not in a portfolio you won't panic sell from. Commit for the long haul. Investing works best over 5+ years to ride out downturns. Those who time the market usually underperform buy and hold strategies. Learn from mistakes. We all make mistakes as novices. Analyze what went wrong to avoid repeating errors like chasing performance. Consider a robo-advisor. Low-cost digital advisors like Betterment provide instant diversification and automation which reduces the stress of doing it alone. Keep records and track taxes. Use your brokerage's tools to maintain cost basis records for taxes and evaluate portfolio performance annually.